In this training, we're covering term loans, specifically short-term and mid-term non-SBA business loans. A term loan is a fixed-term business financing with a defined repayment schedule. Unlike revolving credit, funds are dispersed upfront in a single lump sum. These loans are commonly used for growth, expansion, refinancing, or large one-time business expenses. Repayment occurs over a set term with scheduled payments. Because repayment is fixed, term loans are underwritten differently than revolving credit products and require stronger payment consistency. Term loans are designed for established operating businesses. The business must have predictable cash flow that can support fixed monthly payments. Lenders expect a clear and documented use of funds. This product is best for businesses seeking structured repayment rather than flexible access to capital. Owners must also be prepared for a longer-term financial commitment compared to working capital or lines of credit. Underwriting for term loans focuses on the business's ability to support fixed payments over time. Bank statements remain a primary underwriting document, but lenders place greater emphasis on repayment capacity and overall debt obligations. Debt service coverage is evaluated, even if not formally labeled as such. Credit profile plays a larger role here than it does in short-term working capital products. As with all funding, stability is preferred over short-term revenue spikes. Required documents for term loans include identity, entity, and financial documentation. Government-issued identification is required for all necessary owners, along with business formation and EIN documents. Business bank statements are always required. Tax returns or financial statements may be requested depending on the lender and loan size. When applicable, documentation supporting the use of funds must be provided. Do not submit unnecessary documents unless they are requested. This slide is critical for term loan submissions. The business must be able to support fixed monthly payments comfortably. Lenders have a lower tolerance for revenue volatility compared to revolving products. Existing debt obligations are reviewed carefully because they directly impact repayment capacity. Consistency is preferred over rapid growth, and negative financial trends raise immediate concerns during underwriting. The most common reasons term loans are delayed or declined are tied to repayment risk. Insufficient cash flow to support fixed payments is the primary issue. An over-leveraged balance sheet will often limit or eliminate options. Unclear or unsupported use of funds creates underwriting hesitation. Inconsistent financial reporting or incomplete documentation will slow or stop the review process. There are several items that should never be submitted for term loans. Do not submit unverified projections as a substitute for real financials. Incomplete or partial bank statements are unacceptable. Financial data that doesn't match across the documents will trigger additional review. Outdated, irrelevant, or placeholder figures should never be uploaded. All term loan files must be submitted through the Four Corner Holdings platform. Start by navigating to Clients and selecting Edit Client. Fully complete the Client Info tab and the Business Financials tab. Next, select the required items in the document checklist and upload all supporting documents in the Documents tab. Always confirm that the correct document types are selected. Files are not reviewed until all required information and documents are complete. Once a complete file is submitted, it enters an initial intake review for completeness. Underwriting then evaluates cash flow, repayment ability, and overall risk. If clarification or additional documentation is needed, conditions will be issued. The borrower responds inside the platform, and the file is re-reviewed. The outcome will be approval, suspension pending items, or decline.